The year 2000 marked a turning point in the history of technology and finance. The Super Bowl, America's ultimate advertising showcase, witnessed a tech takeover, with 12 out of the 61 ads filled by dot-com companies. Back then, a mere 30-second ad cost a hefty $2.2 million, which is equivalent to roughly $4 million today. The Nasdaq, a stock exchange heavily weighed towards technology companies, experienced a meteoric rise between 1995 and March 2000. The index surged a remarkable 800%, fueled by investor excitement for the potential of the internet revolution. However, this excitement was short-lived. By October 2002, the Nasdaq had plummeted to a staggering 78%, marking the dramatic collapse of the dot-com bubble. While various factors contributed to this historic crash, legal battles surrounding Microsoft also played a role. The crash wasn't merely a number on a chart. Countless e-commerce and communication companies, unable to sustain their inflated valuations, declared bankruptcy. Even established giants like Amazon and Cisco Systems weren't spared. Amazon saw a significant erosion of its market capitalization, while Cisco lost a whopping 80% of its stock value. This is dot-com crash. But what is the reason for this crash, and why majorly the tech companies affected? Can this happen again? In this video, let's find out what caused this historical crash. In the mid-1990s, the internet began to gain widespread popularity with the advent of the World Wide Web and the development of web browsers like Netscape Navigator. This technological innovation opened up new possibilities for communication, commerce, and information sharing. Between 1990 and 1997, the percentage of households in the United States owning computers increased from 15% to 35% as computer ownership progressed from a luxury to a necessity. This marked the shift of the information age, where economy is based on information technology, and many new companies were founded during this period. At the same time, a decline in interest rates increased the availability of capital. On the other side, the growth of internet sparked a broader technological revolution, with innovations in hardware, software, and telecommunications. Investors became increasingly excited about the potential for internet-based businesses to disrupt traditional industries and generate enormous profits. The low barriers to entry in the internet industry led to the spread of startups. Many of these companies were founded by young entrepreneurs with ambitious visions but little experience in running a business. As a result of these factors, many investors were eager to invest at any valuation in any dot-com company, especially if it had one of the internet-related prefix or a dot-com suffix in its name. Venture capital firms poured billions of dollars into internet startups, often with little scrutiny of their business model or financial fundamentals, hoping to capitalize on the next big thing. IPOs became a popular way for internet companies to raise capital and cash out early investors. Stock prices often surged on the first day of trading, creating enormous wealth for early investors. Valuations of internet companies soared to astronomical levels, far surpassing traditional metrics. As stock prices continued to climb, speculation reached a fever pitch. A combination of rapidly increasing stock prices and confidence created an environment in which many investors were willing to overlook traditional metrics, leading to a stock market bubble. The dot-com bubble's seemingly unstoppable race came crashing down in March 2000. While several factors contributed to the burst, the key culprits were overvaluation. Internet companies were trading at inflated prices far beyond their actual earnings or revenue potential. Excessive spending. Dot-com companies spent heavily on marketing and promotions to build brand awareness and capture market share. This growth over profits mentality led to lavish spending on extravagant business facilities, luxury vacations for employees, and extravagant launch events. Next, interest rate hikes. Alan Greenspan, then chair of the Federal Reserve, raised interest rates several times during the dot-com boom. While some argue that these rate hikes contributed to the bubble's burst, others believe they were intended to address broader economic concerns rather than specifically targeting the tech sector. Next, global economic concerns. News of Japan entering a recession in March 2000 triggered a global sell-off, particularly affecting technology stocks. Comment below if you want me to make a detailed video on Japan asset price bubble. Back to the topic. This recession in Japan, coupled with warnings from publications like Barron's about the financial health of internet companies, further eroded investors' confidence. Next, legal actions. The dot-com bubble's fragility was further exposed by a legal blow. Judge Thomas Penfield Jackson's antitrust ruling against Microsoft cast a shadow over the tech sector. He found Microsoft guilty of monopolization and using its dominant position to unfairly tie products together, while violating the Sherman Antitrust Act. This decision contributed to a decline in investor confidence and the overall value of technology stocks. This led to a one-day 15% decline in the value of shares in Microsoft and a 350 point or 8% drop in the value of the Nasdaq. A combination of factors, including increased scrutiny of business models and a general market correction, led to a sharp decline in the internet stock prices. Many internet startups went bankrupt, while others saw their stock prices plummet by 80 to 90%, wiping out trillions of dollars in market value virtually overnight. The bursting of the dot-com bubble had far-reaching consequences. Thousands of people lost their jobs, trillions of dollars in the market value evaporated, and investor confidence in the tech sector was severely shaken. It took several years for the stock market to recover from the crash, and the scars of the dot-com bubble continue to shape investor behavior and market dynamics today. The dot-com bubble teaches us a valuable lesson. Don't invest based purely on hype. It's crucial to carefully consider the value of stocks and not get caught up in speculative trends. Sustainable business models are key, and it is important to do your research before investing to avoid losing money. That's it for this video, guys. If you wish to learn about the history of Indian stock market, you can click here to watch it. If you have got something out of this video, please like this video and share it with your friends. Also, for more interesting videos like this, subscribe to the channel and hit the bell icon. Thanks for watching, and I'll see you on the next one.